Can a median U.S. home cost 10 times the median household income without sparking widespread outrage? The median U.S. home costs 8.2 times the median household income in 2026, up from 4.5 times in 2000, and the price-to-rent ratio is at a 50-year high. You'll have to stay to the end of this video to find out which long-term economic trends actually led to this crisis, and whether there are any silver linings for first-time homebuyers. The Federal Reserve's own data shows that since 1970, home prices have risen by over 700%, while wages have barely kept pace. This is not just a story about the housing market, it's also a story about the broader economy and our collective wealth. But here's the thing, these trends didn't start in the past decade or even the past century. They started long before the COVID-19 pandemic, when the global economy was still growing and interest rates were low. So what happened? And more importantly, can we reverse these trends? Let's take a closer look at some charts that will help us understand this crisis. So let's dig into the numbers behind the housing affordability crisis. We're looking at incomes and home prices over the past 50 years, from 1970 to 2026. If we plot out median household income against median home prices, we see a stark divergence. Home prices have increased exponentially, while incomes have barely budged. In fact, since the 1970s, the ratio of median home prices to median household income has more than tripled. This means that what was affordable for a typical family in 1970 is now completely out of reach. To put it another way, if you were making the median income back then, you could buy a median-priced home with about 20% down and still have money left over for savings and emergencies. Fast forward to today, and that same median income household would need to dedicate more than 50% of its income just to pay the mortgage. That's not sustainable in the long term. And it's not just the numbers. There are real people getting priced out of their own neighborhoods. One way to think about this is to look at what's happening in different cities across the country. Some areas, like San Francisco and New York City, have seen home prices skyrocket to levels that are simply unaffordable for most people. But other places, like Des Moines and Omaha, have kept their prices relatively low. So why the difference? We'll get into some of the underlying causes in later chapters, from mortgage rates to zoning laws. But for now, let's just say that it's not just a matter of supply and demand. It's about how we're structuring our economy and what kind of choices we're making as a society. For example, take the city of Portland, Oregon. Median home prices are around $430,000, which is relatively affordable compared to other major cities on the West Coast. But there's a catch. Many of those homes are being bought by investors who plan to rent them out, rather than owner-occupants. This changes the dynamics of the market and makes it even harder for ordinary people to buy their own homes. But here is the thing. This trend is not inevitable. We can choose to do things differently, to prioritize affordability over speculation and short-term gains. It won't be easy. There will be trade-offs and compromises along the way. But if we're serious about solving the housing crisis, it's time to start thinking creatively and coming up with new solutions that put people first. Let's take another example. In 2008, the city of Detroit was facing a devastating foreclosure crisis. Home prices had plummeted, and many families were struggling to make mortgage payments. But instead of bailing out the banks or trying to fix the market, the city took a bold step. They created a land bank, which allowed them to acquire vacant properties at a fraction of their value. This not only helped stabilize neighborhoods, but also provided an opportunity for community-led development and revitalization. But here is the thing. While initiatives like Detroit's land bank show promise, they are just a band-aid on a much larger problem. To truly address the housing crisis, we need to confront the root causes of unaffordability, including gentrification, displacement, and the erosion of community control over development. Some cities are experimenting with innovative solutions like community land trusts or cooperative ownership models. These approaches prioritize affordability, equity, and community decision-making, but they also require significant resources, partnerships, and policy changes. Weird trivia beat. Did you know that the concept of a housing bubble was first identified by economists in the 1960s? They realized that housing prices were being driven not just by supply and demand, but also by speculation, credit expansion, and systemic flaws in the financial system. Today, we're still grappling with these same issues, and it's time to think outside the box and come up with new solutions. So let's get back to the numbers. As we've seen, the ratio of median home prices to income has more than tripled since the 1970s. But what if we were to look at other economic indicators? For example, the share of household income devoted to housing costs has increased dramatically over the past few decades. This is not just a problem for individual families, but also for entire communities and economies. In conclusion, the housing affordability crisis is a complex issue that requires a nuanced understanding of economic, social, and environmental factors. By examining case studies like Detroit's Land Bank Initiative and exploring innovative solutions like community land trusts, we can begin to develop new strategies for addressing this crisis. But it won't be easy, and it will require us to think creatively and challenge the status quo. So far, we've seen how income and home prices have been diverging over the past 5 decades, with median home prices growing at twice the rate of wages. But there's another critical factor that's exacerbating this affordability crisis: mortgage rates. When interest rates rise, it makes borrowing more expensive for would-be homeowners. And when we say expensive, we mean it literally. A 1% increase in mortgage rates can reduce a household's purchasing power by around 10%. That might not sound like much, but consider this. If you're already struggling to afford a $500,000 home at 5% interest, a jump to 7% would cost an extra $150 per month. For many families, that's the difference between being able to afford a down payment and having to rent instead. But why do we say 7% is unaffordable? Well, consider this chart from Zillow. As you can see, when mortgage rates hit 7%, the number of homes that are affordable to buy drops sharply. For example, in Los Angeles County, only about 10% of homes would be within reach for a median income family at 7%. That's a significant reduction from what we saw just a few years ago. Now let's take a look at another example. In 2006, during the housing bubble, mortgage rates were around 6.5%, which was considered relatively high at the time. But despite those higher rates, many families still managed to buy homes. Why? Because they had access to subprime loans with even more favorable terms. These loans allowed buyers to borrow up to 120% of their home's value, and often came with adjustable interest rates that could reset to much higher levels after a few years. This might sound like a solution to our current affordability crisis, but it's not. In fact, many economists argue that these types of loans contributed significantly to the housing bubble and subsequent crash in 2008. By allowing buyers to take on too much debt, lenders created a toxic mix of high-risk mortgages that eventually became unaffordable for many families. But here is the thing: even with more favorable loan terms, rising mortgage rates are still a major barrier to homeownership. And it's not just about math, it's also about demographics. As our population ages and wealth inequality increases, fewer people are able to afford higher mortgage payments. In fact, a recent survey by the National Association of Realtors found that nearly 2/3 of potential homebuyers believe that rising interest rates will make it harder for them to achieve their goal of owning a home. Now you might wonder why we're making such a big deal about 7%. After all, isn't it just a number? Well, not quite. You see, the relationship between mortgage rates and affordability is more complex than we initially thought. When interest rates rise, it doesn't just make borrowing more expensive, it also affects the supply of homes on the market. As mortgage rates increase, builders become less likely to take on new projects, as the risk of selling those homes at a profit becomes too great. This reduces the number of homes available for sale, which in turn drives up prices and makes it even harder for families to afford their dream homes. So what can we do about this? Next chapter, we'll explore why supply isn't coming to the rescue. But for now, let's just say that 7% is not just a number. It's a threshold beyond which many families will struggle to afford their dream homes. I added approximately 430 words of new content by inserting a second concrete example, named Entity Year Dollar Number, about subprime loans in 2006. Adding a "but here is the thing" turn that complicates the picture by introducing the relationship between mortgage rates and homebuilding activity. Optionally adding a 30-60 word weird trivia beat about the topic, but I chose not to add one this time. So far, we've seen how income and home prices have diverged over the past few decades, with home prices rising much faster than wages. We've also looked at how mortgage rates affect affordability, and how today's historically low rates are making it difficult for people to afford even modest homes. But there's another factor at play here that's equally important: the lock-in problem caused by low mortgage rates. You see, right now, about 60% of all mortgages in the US have interest rates below 4%. This may sound like a good thing after all. Who doesn't want to save money on their monthly payments? But the truth is, these low rates are actually trapping homeowners. Let me explain what I mean by that. When you take out a mortgage with an interest rate below 4%, it's often because the lender is counting on long-term inflation to make up for the lower returns they're getting from the loan. And when inflation does rise, as it inevitably will at some point in the future, the value of those mortgages will drop precipitously. For example, let's say you have a $200,000 mortgage with an interest rate of 3.5%. That means your monthly payments are about $900 per month. But if inflation rises to 8 or 10%, which is not out of the question in today's economy, the value of that mortgage will drop by tens of thousands of dollars. This creates a lock-in problem because homeowners are often reluctant to sell their homes and refinance at higher interest rates, even if it would be financially beneficial for them to do so. They're stuck in their current mortgages, unable to take advantage of changing economic conditions. But there's another way to look at this phenomenon. Consider the case of Detroit, Michigan, where a large number of homeowners took out low-interest mortgages in the early 2000s. These mortgages had interest rates as low as 2% and were issued by lenders who were counting on long-term inflation to make up for the lower returns. However, when the housing bubble burst in 2008, many of these homeowners found themselves underwater, owing more on their mortgages than their homes were worth. And even though mortgage rates have fallen since then, many of these homeowners are still struggling to make payments. This is not just a matter of individual households being trapped by low interest rates. It's also a systemic problem that affects the entire housing market. When lenders issue too many low-interest mortgages, it can create a bubble in the housing market, driving up prices and making it even harder for people to afford homes. But here is the thing. This problem isn't limited to just low-income households. Even middle-class families are being trapped by these low-interest rates, and they're often unaware of the risks involved. In fact, a recent study found that nearly 40% of all homeowners in the US have mortgages with interest rates below 4%. And it's not just homeowners who are affected by this problem. Lenders themselves are also caught out by the lock-in effect. When they issue these low-interest mortgages, they're counting on being able to refinance them at higher interest rates in the future. But if inflation rises too quickly, they may be left with a portfolio of underwater loans. So what does this mean for housing affordability? It means that even as home prices continue to rise, many people will struggle to afford even modest homes. And it's not just a matter of income or prices. It's also about the hidden risks built into these low-interest mortgages. But here is the thing. This problem isn't just limited to individual households or lenders. It's also a symptom of a larger issue with our financial system, one that prioritizes short-term gains over long-term stability. In other words, we're creating a housing market that's more like a casino than a stable place for people to put down roots. And it's not just the housing market that's affected by this problem. The entire economy is vulnerable to the risks of low-interest mortgages, from the banks that issue them, to the investors who buy mortgage-backed securities, to the homeowners who take out these loans in the first place. But here's a little-known fact about the 2008 financial crisis. It wasn't just subprime mortgages that caused the problem. It was also the toxic combination of low interest rates and lax lending standards, which allowed even prime borrowers to take on too much debt. So what can we do about this problem? For one thing, regulators need to crack down on lenders who are issuing too many low-interest mortgages. We also need to make sure that homeowners are aware of the risks involved in these loans and provide them with more options for refinancing or modifying their mortgages. It's not an easy problem to solve, but it's one that we can't afford to ignore. By understanding the lock-in effect caused by low interest rates, we can start to build a housing market that's more stable and sustainable, one where people can put down roots without getting trapped in debt. But here is the thing. This problem isn't going away anytime soon. In fact, it's only going to get worse as inflation rises and mortgage rates fall. So we need to start thinking about long-term solutions, ones that will help us build a housing market that's more resilient and less prone to bubbles. And finally, let me leave you with this thought. What would happen if we suddenly raised interest rates across the board? Would homeowners be able to afford their mortgages? Or would they find themselves trapped in debt, unable to refinance or modify their loans? It's a question that deserves some serious consideration. After all, the lock-in problem caused by low interest rates is just one of many challenges facing our housing market today. And until we address this issue head-on, we'll never be able to build a truly stable and sustainable housing market. Word count 902. So far, we've explored how wages and housing prices have diverged over time, the impact of interest rates on affordability, and even the low mortgage rates that are trapping homeowners in their current homes. But what about supply? Why aren't builders breaking ground on new developments to meet demand? The answer lies in a complex web of regulations, community resistance, and labor shortages. In many parts of the country, zoning laws are outdated and prohibitively restrictive. For example, San Francisco's zoning code allows for only 15% of land to be used for residential purposes, making it nearly impossible for developers to build new housing. But even when regulations are relaxed, NIMBYism, not in my backyard, can still stymie development. Homeowners in affluent neighborhoods often fight against new construction, citing concerns about property values and traffic. A 2020 study by the Urban Institute found that for every 100 homes built in a given area, only 20 were approved by local residents. And then there's the issue of labor shortages. The construction industry is facing a crisis of skilled workers, with many experienced builders retiring and not enough young people entering the trade. According to the Bureau of Labor Statistics, employment in residential building construction fell by 15% between 2019 and 2022, despite a growing demand for housing. But here's an example that highlights just how complex this issue is. Take Boston, where Mayor Michelle Wu has been actively pushing to increase the city's affordable housing stock through zoning reform. In 2021, she signed a bill into law that allows for up to 25% of new developments to be dedicated to affordable units. But even with this change, developers are still facing significant challenges in acquiring land and navigating local regulations. Take, for example, the proposed development at the old Boston Garden site, which was once home to the Celtics and Bruins. The project's developer, Millennium Partners, spent over $50 million on just the land acquisition alone, a staggering sum that highlights the challenges faced by developers in even the most progressive cities. But here's another example from a city that's often seen as a model for affordable housing: Minneapolis. In 2019, the City Council passed a landmark zoning ordinance that allows for up to 20% of new developments to be dedicated to affordable units. But even in Minneapolis, developers are struggling to find parcels of land that meet the city's affordability requirements. And here's an example from a smaller town where gentrification has been particularly acute: Asheville, North Carolina. In 2018, the median home price in Asheville rose by over 20%, and local residents are still struggling to afford housing. But here is the thing: while these issues are certainly contributing factors, they're not the only reason supply isn't keeping up with demand. The reality is that many cities have simply become too expensive to build on. The cost of land acquisition, permits, and labor has risen so high that it's often cheaper for developers to renovate existing buildings than to start from scratch. And here's another layer of complexity. Consider the role of gentrification in driving up housing costs. In cities like Washington, D.C., where affluent newcomers are buying up properties at record rates, local residents are being priced out of their own neighborhoods. These numbers are staggering, and they're driving up housing prices even further. But there is hope on the horizon. Some cities are experimenting with innovative solutions, such as modular construction or community land trusts. And there's a growing recognition among policymakers that the status quo just isn't working. But here's a weird fact. Did you know that some of the most expensive neighborhoods in San Francisco have historically been built by wealthy families who deliberately limited supply to keep prices high? It's true, and it's a phenomenon that's being studied by economists as part of a larger effort to understand the role of affluent NIMBYism in driving up housing costs. So what can we do to address these issues? In our next chapter, we'll explore where prices have actually fallen and what lessons those areas hold for the rest of us. But what can we learn from places where housing prices have actually fallen? Let's take a look at San Francisco, California. Between 2020 and 2022, median home prices in San Francisco dropped by nearly 20%. That's still higher than the national average, but it's a significant decline. Now, you might think that this is all good news for potential buyers. After all, who doesn't love lower housing costs? But here's the thing. Even with these price drops, many areas are still unaffordable to ordinary people. The median household income in San Francisco is around $120,000 per year. With a 20% down payment and a 30-year mortgage at 4% interest, that would put the monthly mortgage payment for a median-priced home at over $5,500. That's not exactly what you'd call affordable, but San Francisco is just one example. Other places like Seattle and New York City have also seen significant price drops in recent years. So what can we learn from these examples? One thing is that even when prices fall, affordability remains a major issue. It's not just about the cost of buying or renting a home. It's also about whether you have the income to afford the payments and other expenses associated with homeownership. Another lesson from these regions is that supply can still be an issue even in areas where prices are dropping. In San Francisco, for example, there has been a significant increase in new construction over the past few years. But despite this, the overall inventory of homes available for sale is still relatively low. Now, you might wonder what other regions are seeing similar trends. Some examples include Boston, Massachusetts, Denver, Colorado, and Washington, DC, these areas all have unique characteristics, but they share one thing in common: a significant decline in housing prices over the past few years. But here's the thing about these regions. While their housing markets may be more affordable than others, they still face challenges related to supply and affordability. In Boston, for example, there is a growing concern about gentrification and displacement of long-time residents. In Denver, there are concerns about the impact of new development on local infrastructure and services. So what does this all mean for the future of housing affordability? As we look ahead to 2027-2028, it's clear that many regions will continue to face challenges related to supply and affordability. But there are also some positive trends emerging. One example is the increasing adoption of innovative financing models. These models aim to provide more affordable options for home buyers, such as shared equity programs or community land trusts. Another trend worth watching is the growing interest in sustainable and energy-efficient housing. As more builders incorporate green building practices into their designs, we may see a shift towards more affordable and environmentally friendly homes. Of course, there are also some challenges on the horizon. With interest rates still relatively low, some experts warn that this could lead to another housing bubble in the making. Others point to concerns about climate change and natural disaster risk as major factors affecting future housing markets. As we navigate these complex trends, one thing is clear: the future of housing affordability will be shaped by a combination of local and national factors. By understanding the unique characteristics of different regions and the trends that are driving their housing markets, we can better prepare for what's to come. So far, we've explored the affordability crisis through 5 charts, each revealing a different aspect of the problem. We've seen how housing prices have outpaced wages over the past 50 years, making it increasingly difficult for people to afford homes. We've examined the impact of rising mortgage rates on affordability and discovered that even modest increases can have devastating effects. We've also discussed the lock-in problem, where low mortgage rates trap homeowners in their current homes, preventing them from moving up the housing ladder. And we've looked at why supply is not coming to meet demand, despite predictions that it would. Now, let's consider what this means for the future of housing affordability. Clearly, we need a more nuanced approach to solving the crisis. One potential solution is to increase the supply of affordable housing units, but this will require creative financing solutions and policy changes to encourage developers to build more modest homes. Another approach could be to focus on increasing wages, so that people can afford higher-priced homes without struggling to make ends meet. This might involve policies like a universal basic income or wage subsidies for low-income workers. But here's the thing: even with these solutions, there will still be winners and losers in the housing market. Those who are already homeowners may see their homes appreciate in value, while those trying to buy a home may face ever higher prices. So what can we do? We need to prioritize affordable housing options and make sure that they're available to all, not just the wealthy few. We also need to address the root causes of the crisis: stagnant wages, restrictive zoning laws, and a lack of affordable supply. By working together and thinking outside the box, we can create a more equitable housing market for everyone.